Welcome back to the ChartledGer Deep Dive. Today, we are really plunging into the latest from, well, one of the world's most talked about companies, Tesla. We're getting right into their Q2 2025 earnings, pulling insights directly from their earnings call, analyst reports, financial summaries, the whole lot. Our mission today, pretty straightforward. We want to decode the raw earnings numbers, figure out what the financial analysts are really saying, and then, maybe the most exciting part, dive deep into Tesla's future plans. Robotaxi, Optimus, all those big strategic bets. You'll find the sources we've looked at paint a really comprehensive, maybe sometimes even conflicting picture of where Tesla stands.
Absolutely. It's a fascinating situation, quite complex. Our goal is really to help you cut through some of that noise.
Okay.
Because you've got the hard numbers telling one story, right? Then these future ambitions,
Yeah.
they paint a completely different picture.
Exactly. So let's dive straight into those numbers. Q2 2025, what were the big takeaways? Did they hit expectations? Any surprises?
Well, the headlines weren't exactly stellar. Total revenue came in at $22.5 zillion. Now, that's a 12% drop year over year, which, to put it in perspective, is their worst quarterly revenue decline in years. And it actually fell short of the $22.64 billion analysts were hoping for.
Okay, so revenue missed and a pretty significant dip too. Did that trickle down to the bottom line, earnings per share?
It did, yeah, though there's a bit of nuance. Adjusted EPS, that's often the focus for analysts, was $0.40. So slight beat over the $1.39's consensus.
Yeah.
But GAAP EPS, which gives you maybe a truer picture of profit, that fell to $1.33, down 18% year over year. And operating income, that also missed significantly, $923 million versus the $1.23 billion expected. So yeah, a broader squeeze on profitability is definitely visible there.
Okay, beyond the financials, what about the operational side? Cars, how many did they actually, deliver and produce?
Right. Deliveries fell 13% year over year, came in at 384,122 vehicles. Production, though, was basically flat at 410,244. And that gap between production and deliveries, it's more than just a number. It sort of suggests, well, it points towards potential demand concerns, doesn't it? Even if they can't make the cars, are people buying them at the same rate, especially with tariffs adding pressure?
And how did that affect their margins, profitability per car?
Yeah, the operating margin shrank quite a bit, dropped 219 basis points year over year. So that's a 2.19 percentage point drop. It landed at just 4.1%. Compare that to around 6.3% this time last year.
Wow.
Yeah, it's a very noticeable compression.
Less revenue, fewer deliveries, tighter margins. Sounds like free cash flow must have taken a hit too. How bad was that?
It definitely did. Free cash flow plunged down to $146 million. That's about an 89% drop from last year. Now, that looks alarming, right? And it is a sign they're struggling a bit to turn revenue into actual cash. But the key insight here is how it relates to funding those big future projects. Are they self-funding or dipping into that huge cash pile? This suggests that while they still have a lot of cash, about $36.8 billion, the rate they're generating new cash from operations is, well, concerning for sustained investment without burning through reserves faster than maybe planned.
That's a really crucial distinction. What else was hitting revenue? I remember hearing about regulatory credits, tariffs.
You're right on both counts. Regulatory credits fell sharply, $439 million, down from almost $890 million a year ago. And that's expected to keep dropping because of this one big, beautiful bill, the OBB, which phases out penalties for traditional automakers. So that revenue stream is shrinking. Tariffs were another big one. Costs went up by about $300 million just in Q2 sequentially. Two-thirds hit automotive. And they expect more increases because of the lag between production changes and sales.
And the market reaction. I saw some volatility.
Yeah, the stock was definitely jumpy in after hours right after the release. Then, as the details came out on the earnings call, it generally trended downwards. Markets were clearly showing some concern.
Okay, those are the raw numbers. Now let's shift to the analysts. What are they making of this? Is it all doom and gloom, or are they finding silver linings?
Well, near term. Definitely caution. Lots of analysts picked up on Elon Musk's own warning, actually. He said Tesla could face a few rough quarters. He pointed to Q4, Q1, maybe even Q2 next year, citing things like fading EV tax credits, general economic uncertainty, and those tariffs we mentioned.
A few rough quarters. Given those numbers, that almost sounds like an understatement. Are analysts just accepting that explanation, or do they see deeper issues?
Well, some sources framed it as a weird transition period,
Right.
made worse by policy shifts that maybe artificially boosted demand before. But others pointed out, quite rightly, that this is the worst revenue decline in over a decade. That signals pretty strong headwinds, maybe more than just a temporary blip. So it's a mix. Some see it as policy-driven and temporary. Others maybe see a more fundamental shift happening in the EV market.
Right, Tesla always has this split narrative, doesn't it? Today's performance versus tomorrow's big bets. With Q2 looking tough, are analysts still bullish on things like autonomy, or is that starting to fade?
That's where the long-term optimism still, well, it really shines through. Analysts mostly agree. Robotaxi, Optimus, the affordable model. These are the key potential drivers down the road. Seeking Alpha, for instance, noted that even with this short-term profit pressure, autonomy, and robotics, that's still Tesla's core promise for future value. It keeps the whole valuation debate so lively.
Speaking of valuation, always a hot topic with Tesla. How's it holding up now?
It's definitely under the microscope. Some analysts are saying, look, the current valuation,
Yeah.
maybe not justified by these weak Q2 numbers. They're suggesting caution, maybe even bearish positions. But it's definitely not unanimous. You've got folks like Benchmark's Mickey Legg, a big bull who actually raised his price target from 395 to 475 far.
Oh, really?
Yeah, believing that robotaxi leadership potential is still baked into the stock price.
That's a huge difference in opinion. So analyst targets are all over the place.
Absolutely. You see conservative targets, maybe 275, 335 range. Then you see the super bullish ones like $475. It really boils down to how much weight you give the current financials versus that, somewhat speculative long-term potential of AI and robots.
And competition. Still leading the EV pack globally.
Reports are highlighting that actually Tesla is currently lagging behind BYD in global EV sales, and they're facing tougher competition in key places like China and Europe. So the competitive landscape definitely heating up.
So bottom line from the analysts, what's the summary sentiment?
I'd say it's mixed, leaning towards cautiously bearish for the near term because of the revenue drop, the margin pressure, falling deliveries. But there's still this strong, almost unwavering, bullish long-term view, contingent, of course, on successfully executing those huge autonomy plans, robotaxis, especially rolling out the affordable EV smoothly and getting energy services back on a strong growth track.
Any specific analyst quotes that stood out, especially capturing that tension between the short-term pain and the long-term gain?
Yeah, a couple. Morgan Stanley said something like, Musk's politics are a headwind.
Yeah.
But TSLA remains a top pick with a $410 target. That shows, even with acknowledged friction, some see the core potential as massive. And Dan Ives at Wedbush, always a vocal bull, basically said, look, fundamentals are weaker now, but autonomy could be worth $1 trillion. He used that wartime CEO narrative again. It really highlights that split, immediate struggles versus potentially enormous future value.
Okay, that really sets the stage for the future vision, doesn't it? Robotaxi, AI, Optimus. Let's dig into that. Starting with Robotaxi. What's the latest there?
The big news is the commercial launch in Austin. Paying customers are using it now. Musk said they've already expanded the service area, made it bigger and longer. And the goal, it's pretty ambitious. Expand tenfold just in Austin.
Tenfold in Austin. Are they looking beyond Texas too?
Oh, absolutely. The ambition is huge. They're actively seeking regulatory approvals for places like San Francisco Bay Area, Nevada, Arizona, Florida. Several key markets. The target they threw out: have autonomous ride-hailing available to half the population of the U.S. by the end of 2025.
Half the U.S. population by end of next year.
Yeah, if they get those regulatory approvals, that's the key caveat.
That's incredibly aggressive. What are the hurdles, though? Is it just regulation, or are there other practical things analysts worry about?
That's a great point. Regulation is huge, obviously. But Tesla's also emphasizing safety. Musk said they're being very cautious, paranoid about safety, don't want to take any chances. They cited over 7,000 miles driven in Austin already with no notable safety-critical interventions. So they're trying to build that safety case. But the practical reality is scaling safely and getting regulators and the public comfortable with it. That takes time.
And the economics. What's the cost per mile projection, and how would it work for someone like me owning a Tesla?
Musk projected sub 30 cent per mile potential over time. But that's for purpose-built vehicles like the Cybercab, designed for gentle rides. For the current cars in the fleet, it would higher, maybe around 50 cents per mile. Still competitive, they argue. They expect a material impact on our financials around the end of next year from this. And he seemed confident that by next year, in the U.S., owners will be able to add their personal cars to the fleet. Sort of like Airbnb for cars, with vetting rules that could seriously change the ownership cost equation.
It's interesting. What about full self-driving, FSD, adoption rates, and this claim about safety?
Yeah, they reported a significant uptick since version 12 came out in North America. A 45% increase in subscription rates, 25% increase in overall penetration. And they highlighted a new safety report stating cars on FSD are statistically safer. Musk used the phrase 10 times safer compared to human drivers.
10 times safer. Bold claim. So why isn't everyone using it then? What's the holdup?
Surprisingly, they say the main challenge is just educating existing owners. Many haven't even tried it. It seems to be a case of seeing is believing, getting people over that initial hump of trying the tech and trusting it.
Okay, shifting gears. The affordable models. What's the timeline there?
Production apparently started as planned, first half of 2025. But the ramp-up in Q3 might be slower than they initially thought, partly because they're focusing on delivering existing models before the EV credit expires, and partly just the complexity of launching a new product line. The goal is still an affordable car, but without crushing their own revenue or margins.
A tricky balance. How do they achieve that affordability long-term then?
The key, they argue, ties back to Robotaxi. If owners can let their affordable car earn money on the network when they aren't using it, well, that makes ownership drastically cheaper, like offsetting your mortgage by renting a room.
Right. Okay, now Optimus, the humanoid robot. Musk calls it potentially the biggest product ever. What's new?
The Optimus 3 design is apparently exquisite. No major flaws seen yet. Prototypes expected in about 3 months. Production starting early next year. Musk sees it as a profound game changer, highlighting Tesla's edge in real-world AI compared to, say, Waymo. He even described the lab looking like the set of Westworld.
And the production scale, it sounded massive.
It really is, to target. Roughly making 100,000 Optimus robots a month in 60 months. That's 5 years.
100,000 a month.
A month. Musk called it a reasonable aspiration. I mean, if they achieve that scale,
Yeah.
it really makes you wonder what the limits are. They're focusing on intelligence density for the AI hardware efficiency over just raw size.
Incredible vision. What about the AI infrastructure behind all this? Dojo.
Dojo 2, their AI training supercomputer, should be operating at scale next year, aiming for compute power like 100,000 NVIDIA H100s. Just a massive amount of power. They're also building a new AI factory, targeting end of next year for production. Musk sees it all converging, same basic chip architecture for cars, robots, Dojo. He even hinted their chip might be so powerful it needs to be nerfed for export outside the U.S.
Wow. Okay, quickly then. The energy business, how did that part do?
Actually, a bright spot. Record power deployment in Q2. Sequential improvement in margins for energy and solar. Highest gross profit ever for the segment. Despite headwinds like tariffs and expiring credits, especially residential, industrial customers seem willing to absorb some tariff impact. Storage is increasingly seen as key for grid efficiency, especially with all the energy AI is going to need.
Any U.S. manufacturing investment there?
Yes, their first LFP battery cell facility, that's lithium iron phosphate, should be online by year-end. Cheaper, more durable batteries, crucial for storage. And a third mega factory planned near Houston for 2026.
Any other key financial or strategic points before we wrap?
Just a couple. Operating expenses are up, R&D for AI, stock compensation, depreciation on all that compute hardware. Those investments will continue. Also, other income got a boost, about $284 million, mostly from mark-to-market gains linked to Bitcoin volatility. Quite a swing from the loss last quarter. And capital spending is expected to top $9 billion for 2025. Massive investment continues.
And that new master plan.
Right. They're working on it. To articulate this fundamental transformation from a, quote, pre-autonomy world to a post-autonomy world, that really sums up the huge shift they envision.
So let's try to recap this deep dive. Tesla's Q2 2025, undeniably tough financially. Headwinds from tariffs, legislation, maybe some softening demand in the core car business. But as we've heard, this short-term pain is being framed internally and by some analysts as this necessary, maybe difficult transition towards potentially stratospheric long-term value from autonomy, robots, energy, the works.
It really is that classic Tesla story, isn't it? Push through the current challenges for a revolutionary future. It's like a financial high-wire act. Success really hinges on executing these incredibly complex, potentially world-changing projects.
Absolutely. So as you think about all this, consider the implications. A world where your car literally drives itself off to earn money while you sleep, where humanoid robots are maybe common, helping out. How does that post-autonomy world fundamentally change things? Our economy, work, just daily life. It's definitely a lot to mull over.